G'day folks, there is no doubt about it, we are living in one of the most peculiar times when it comes to the Canadian economy, especially with these dividend stocks, whether it's a buying opportunity of a lifetime or a sign of worse times ahead. I'm going to leave that up to you as we review 5 insanely high yielding dividend stocks that are actually Canadian conglomerates, and I've been getting a lot of comments, a lot of questions around these topics, like this one saying, well, my BCE holdings are taking a hit. It's been in our family for 4 decades. Did I sell? No, but did I turn off the drip to use the dividends for other investments? Yeah, might as well, right? Because they're a little fearful of where the stock is going. And it's really hard to be greedy when others are fearful, watching your stocks plummet every day against the backdrop of like the S&P 500 hitting new record highs. So if you're on your path to financial independence, to perhaps one day retire early, want to join me on this journey and have a well-rounded conversation about these stocks, consider hitting that like button and subscribing while you're down there, because Bell is now down 20% year to date with a 9.28% dividend. Since we last spoke about this, it has knocked out a decade worth of capital gains, which is just unimaginable to consider that we're back to like 2014 level like returns. And just looking at that dividend yield to show you how absurd this is, pretty much in the entirety of my life, Bell has never really yielded this high of a dividend, and only as of recently, within the last couple of years, has this dividend gone absolutely bananas. Like, it is insane that this thing is over 9%. Even with earnings, it was able to beat the last analyst expectations on earnings, but the interest rates are absolutely suppressing this market. Bell announced, laying off another 43 technicians, but this was part of their bigger plan they announced back in February to do a bunch of job cuts, which I think is great. It offers more efficiency to the business. I think when you get into these tougher market environments, you have to make these tough decisions so we can come out on the other side of this market in a much stronger position, especially as interest rate cuts continue to persist. I don't know if we're on the cusp of the greatest buying opportunity of a lifetime with Bell, or again, if this is a sign of worse to come. We did see shareholders come in from TRC Capital that offered a mini tender offer, which is hilarious because essentially they came in and they want to buy 2.5 million common shares. Now, that's a very hard thing to do when there's only so many shares traded in a given day, right? So they offered shareholders saying, hey, at $43.40 per share, which was significantly below the current market price, we'll buy a crap ton of shares off you. And Bell was kind of, telling shareholders, don't do this. Don't sell into these tender offers because it's not a good strategic thing for an investor. They're offering it below the value of the stock, yet you just give it a little bit of time. Right? And you look at where the stock is now, and we're at $43. So that tender offer actually wasn't that bad. And I find it fascinating because clearly somebody sees an opportunity here and they're trying to take advantage of it as much as possible. So, I'd like to look into TRC Capital and see what's going on there. And in tandem to the other giant that I like a lot is Telus. And honestly, I'm a bigger fan of Telus just because I think their core businesses are fundamentally stronger. Bell is laying off a huge percentage of their media division. They own CTV. They had all these like little regional, little tiny, your local TV stations. They ended up just wiping them off the face of the Canadian map, which the government wasn't too happy about, or at least citizens weren't, because the government helped subsidize some of that dealing, which was funny. They signed off on it, right? But still, like, Bell's got Crave. They've got some subscriber-based stuff that's a little bit more stable for them, but I don't like the media division. Media is very, cyclical in nature, and the only media I'd want exposure to, more or less, is YouTube, right? But that comes with its own risk with Google's fundamental businesses. So Telus gives us this exposure to security, to telehealth. They have like some of the fastest growing revenue in the industry, and it is still down 13% year to date with a 7.5% dividend, which is crazy. Also wiping out pretty much a decade's worth of gains in the same boat that Bell's in, right? And their dividend recently hockey sticked. I mean, it is also at record high yields we haven't seen in 20 damn years. Like, how crazy this is? And the fact is like, I know for sure that, Telus, Bell, like, they can still afford the dividend. They're not cutting them. They're looking to increase the dividends. They're supporting the dividend by layoffs and other, things they can do with the business. But I can't get over this. Look at this. Like, the last time dividend yields were this high was back in 2009. It has been well over a decade, and only 3 times in the last 20 years has the yield spiked this high. Is this a buying opportunity? Like, what's going on here? And Bell's still expanding. I mean, if you read into their news, they're investing money everywhere. They invest $6.6 million in the North Shore region, invest $8.5 million in the Lower St. Lawrence region, $6 million in Gaspé Peninsula, and $10 million in New Westmore. The mental health index, 42% of workers feel exhausted after work. Excessive workload is leading to cause of burnout, like, because obviously they have telehealth. They're investing 14 million in Kelowna. They're just investing. Like, the infrastructure they're building out right now and the partnerships they have going on, the company is not going anywhere. They are primarily an infrastructure company that you need in Canada. And there's only two majors, three with Rogers, all right? Like, you talk about Rogers, but Telus and Bell, I think, are the most disclosed. So shifting over to Toronto Dominion Bank, which yields 5.36% against Bell's Telus's 7.55% and Bell's 9.28%. I mean, it's not nearly as attractive, but keep in mind, this is Canada's second largest company. We are talking about a $133 billion market cap, and TD is now trading down 29%. It's kind of gone into a quiet period because the last bit of news that really came out was this money laundering that could yield a $4 billion fine. I don't think it's going to be that extreme personally, and obviously I think a lot of that news is already baked into the stock, and I think we're soon going to be finding a bottoming here. At least I hope so for investors that have been buying this up against, again, the backdrop of a market that's been hitting all-time highs. It's very hard to persist in a market where everything is doing so well, or seems to be doing so well, but realistically the lower half of the market and a lot of companies like this just aren't. And these are world-renowned companies. They're going to be around for a very long time. I mean, look at this. In the last 20 years, over 20 years, literally for 3/4 of my entire life, you would never seen a yield this high on Toronto Dominion Bank. The second largest company in Canada. You know how crazy this is? The last time was 2002 at a 4.65% yield. I think this is the US ticker for it, but I mean, we're at 5.36%. Now, that might be the Canadian yield, but like, unbelievable. Look at that. I mean, you know, true buying opportunity or what? I'm taking advantage of this through VDY, obviously, but I still debate on maybe diversifying into some of these other stocks that we're going to talk about. But the only thing holding TD back right now, it has nothing to do with these fines. It has nothing to do with the negative media. It has everything to do with loan loss provisions, right? Because they have been hitting record revenues. This company has actually been growing relentlessly in the backdrop of what is supposed to be a terrible Canadian market. Look at this. Their revenue basically year over year went from 12.39 billion to 13.8 billion. Just over last quarter from 13.7 to 13.8. They're growing pronouncedly, like insanely well. And the only thing stopping them is loan loss provisions, which haven't hit the bottom line. It's not like these are defaults that are happening right now. It's just money that they're putting in their war chest every quarter just to protect themselves, right? So that is hindering the net income. I mean, if you take a look at just the net income here, it was 2.56 billion versus a year ago at 3.3 billion. But you're playing this game where eventually they're going to stop putting loan loss provisions aside unless the entire Canadian economy collapses. If you believe that's going to happen, then don't buy the stock. It's as simple as that. But in the meantime, the fundamentals of the business continue to grow. They're just putting money aside for their own protection, and otherwise everything else looks amazing. So, you know, it could just be, you know, a spring winding back. Remember, these stocks can recover very, very quickly. I mean, you take a look at the crash here in 2020, and just within, you know what, a few months, 6 months, not even a year, this stock jumped up massively. I mean, you were seeing 20, 30% gains within a couple of years here. You were up 50, 60, 70, 80%. I mean, these gains can really come quick, so just be aware of that, right? And same in tandem with Bank of Nova Scotia, the second highest dividend yielding Canadian bank here. And I'm not the biggest fan of BNS, but you have to recognize that, again, these companies are highly stable. The dividend yields are at record highs. And if you're looking for income and you're in retirement, I mean, these are great to me. I'm not a financial advisor, but they look pretty healthy. Let's talk about Enbridge here as well. Like, Enbridge is another one of these companies that I think is the third or fourth largest company in Canada, also with dividend yields. It really hasn't seen since the 1990s, which is crazy to consider. And this dividend yield is because they've been paying out so much and increasing it so dramatically since, for the last several years, that the stock hasn't done enough to catch up. And that might be for dilutive measures, or who really knows exactly what's kept the stock relatively suppressed. But for the stability that you're getting in this company, it's a true infrastructure company to lock in a 7.47% yield. Again, guys, their earnings are down a bit because on the back of oil, that's been a little bit more suppressed on a year over year. It's cyclical in nature, but very stable nonetheless. You usually see from 10 to 20% fluctuations in their revenue. Like, nothing too material that it's going to impact their actual payout. I mean, you take a look at their operating revenue here, 11 billion versus 12 billion for this 3 month ending this time last year, because obviously commodity sales were down slightly, gas distribution sales down, and then you take a look at transportation and other services are up because they own literally the largest pipelines in North America, and there's always a need to be moving oil, natural gas, all that energy. I mean, you walk around half the municipalities in Ontario, you're in Toronto, go look behind these buildings and you'll see pipes. And 9 times out of 10 on those pipe meters, it says Enbridge, because they're piping the natural gas and the heating for these buildings. So Enbridge is another really interesting one. And then finally kind of got Power Corporation here. And the only reason Power Corporation is so interesting is because it's a large insurer. They do a lot with investment capital, and they also own a percentage of Wealthsimple. Wealthsimple, I don't think is a big enough investment for them to impact, the earnings in any major way. It's more just like a capital gain investment for them. But the stock is now up 22%, 25%, still down, 10% from their all-time high. And this company has been on fire, and I'm surprised they haven't hit an all-time high as, in similar to Manulife or some of these other insurer companies, because a lot of banks are making a crap ton of money on investment commissions, fees. Insurance companies have so much cash they have liquid that the only thing they can do with it is put it in high interest accounts or bonds or GICs, and that has led them to making record revenues. So Power Corporation is paying a 5.76% dividend yield. They've done a wicked job at going from 30 cents a decade ago to today at 56 cents. So you're getting almost the doubling of your dividend. They've done a great job, high yield, doubling the dividend. And if you take a look at their earnings here, their net earnings, just zoom right in so you can see this, have gone from 313 million to 709 million for this quarter. Which is crazy. I mean, the growth trajectory here has been beautiful. Their net earnings are up massively. Dividend yield, their payout is like 50%. I mean, they got tons of room to continue to grow the yield, which again has been showing some inclines here, coming down a little bit from the recent highs, but also very, very interesting. However, you want to pay attention to book value, because I think this company is one of these that trade in and out of book value a little bit more in tandem than maybe real estate investment trusts do, because more or less, you're looking at a 33 book value, which is just their net assets, right? And if you take a look at that current stock price at 39, it is above the book value, but not really by much. And what makes it more intriguing, even though you're paying that premium above NAV, is the fact that they've been buying shares back pretty aggressively here. Not aggressively to a major extent, but from 666.8 million to 650.6 million is a nice, year over year, kind of quarter over quarter. We're seeing a continual share buyback program, which again helps inflate the value of the stock, especially with their low payout ratio. They're very stable industries to be in, and they're proving to be very persistent for income. So I think this is probably one of the best stocks to buy for stability. It's not nearly as volatile from the stock price compared to some of these other ones. And if you can pick it up on a dip, you're not getting like a huge value in the dips, but just enough that you can inch out a little bit more yield, and you're usually getting some capital gain on top of it. But I will, however, pass that question off to you. This is one of the weirdest markets for Canada I've ever seen. And honestly, if I was smart, I should even be taking some money and just starting to take advantage of it, because I always just go back to that mindset of, $10,000 in Telus or Bell today will pay my internet and phone bill pretty much in perpetuity for the rest of my life. At this rate, if you're getting a 10% return almost, 10K investment, that's $1,000 a year, man. My phone bill is like $300 a year at best. But I'll pass that question off to you. I'd love to know what you think in that comment section below.